So, how much risk you take with your investments, as many listeners know, is one of the single most important determinants of your expected investment returns. And that makes choosing an asset allocation, which is the mix between riskier stocks, safer bonds, and maybe other assets in a portfolio, one of the most consequential decisions that every investor has to make. But how do you figure out how much risk you should take? And I think the second question that's really important to think about is what even is risk? Because if we're framing risk as volatility, that's one thing. That's not necessarily the best way to think about it in all cases. So I'm going to start off talking about risk as the risk of an investment declining in value. But I do want to be super clear, and I will come back to this later in the episode, that that's not the only way to think about risk. And I think in a lot of cases, it's a deficient way to think about risk. So we're using a framework here to talk through how much risk you should take when risk is framed as volatility. We're using a framework from John Grable, who's an academic who has done a huge amount of work on this concept, on behavioral, on risk profiling for investors. He's got a bunch of published academic papers. He's also got a research book, I don't know what you call it, like a PDF for the CFA Institute. So we're really using his work and his framework for determining someone's risk profile. So the things we care about in making up the risk profile are your behavioral loss tolerance. That's your ability to sleep at night and not panic when a risky investment drops in value, not panic sell. Your ability to take risk. So behavioral loss tolerance is pretty subjective. It's pretty psychological. Ability to take risk is much more objective. That's your capacity to hold a risky asset without needing to sell in the short term to fund your living expenses. So like if the stock market crashes, can you still pay your rent? Or do you need this cash that you are considering investing to fund your normal lifestyle? So behavioral loss tolerance, ability to take risk. And the last piece is your need to take risk. So that's the amount of risk that you need to achieve the expected return needed to meet your goals. And all three of those things kind of interact with each other to form a risk profile. Any comments from you guys before I keep going?
Yeah, I guess a couple things. The ability to take risk, I think a lot of people kind of forget things like insurance, like disability insurance and those types of things when they're considering their ability to take risk. Like they think about their current financial position, but that usually includes their income. So just something to keep in mind, that the sort of ability to take risk, or like the quantitative side of that, should include more than just like your current net worth. It's all about the kind of foundational stuff too, right? Like the insurance, disability insurance and that. And then I have a question for you. Maybe you're going to get to this later, but do you find, you're probably going to answer this anyway, but does loss tolerance, like the behavioral risk tolerance piece, do you know if that changes anytime, or what does Grable say about that changing through time?
I believe behavioral loss tolerance is supposed to be a pretty stable psychological characteristic.
Mm-hmm.
Yeah. So your ability to take risk will change over time. Your behavioral loss tolerance, I think, is supposed to be pretty stable.
Yeah, and I think that's the limiting factor too, isn't it? I think we'll talk a little bit about this. I mean, all three of those pillars are important, but at the end of the day, doesn't matter what your ability or your need is if you don't have the behavioral, the stomach for to tolerate, volatility of a certain level. That's got to be the limiting factor. That usually is the one that determines your ultimate decision.
Yeah. So that's exactly what I say next in my notes here. I say that behavioral loss tolerance is an important constraint on asset allocation. And we can talk about all the fancy stuff like portfolio optimization and Sharpe ratios and expected returns and uncorrelated assets. And people love to talk about that stuff. But you ultimately need to have a portfolio that you can stick with through good times and bad. And keeping in mind that all portfolios, no matter what you do, unless maybe you're holding a real return bond that's perfectly matched to what the liability you're funding. And even then you're going to have volatility. You just won't have volatility relative to the liability. But anyway, you have to have a portfolio you can stick with through bad times, because every portfolio, no matter what you do, what you try and do to prevent it, is going to have bad times in some way. And then we know, and this is kind of what you were just alluding to, Dan, investors tend to sabotage their own returns by selling stuff after it's done poorly, or giving up on the strategy after it's done poorly, and investing in stuff after it's done well. And there's lots of different research on investor return gaps, how they underperform asset classes or funds or whatever because of that behavior. So ideally, having an asset allocation that you're really comfortable with is going to mitigate some of those common behavioral issues that can be a big drag in returns over time. Behavioral loss tolerance it's subjective, and it is unique to each individual. And it can be broken down, again, using John Grable's framework into 6 elements. We have your risk tolerance, which is your willingness to engage in financial behavior with an uncertain outcome and the potential for loss. Risk preference, which represents your general preference to take more or less risk. Financial knowledge, which is your level of financial education, training, and experience. And interestingly, higher financial knowledge is typically associated with a higher behavioral loss tolerance. Investing experience, which is your experience with investing specifically, and that's distinct from financial knowledge because you can be financially knowledgeable but have limited experience with investing. And again, investing experience is generally associated with being more comfortable with risk. Risk perception, which is your subjective assessment of the riskiness of investing, separate from the objective reality of it. And that can be influenced by the media, by your social environment, or just by a lack of understanding of financial concepts. And again, the interesting point there is that people who perceive investing to be more risky tend to be less adaptable to market volatility, which it kind of makes sense when you think about that. If someone thinks investing is really risky or thinks it's riskier than it actually is, however you define that, it's going to be harder for them to live through a period of market volatility. And then the final element here is risk composure. This is a really interesting one. And Dan, this is something that I think you've talked about in the past. Risk composure is your actual behavior during difficult market conditions. And the only way to know that is to have lived through market declines and the accompanying narratives. I think that's a really important part. And the accompanying narratives about why that crash is different. Because it's never like, oh, the market dropped 20%, but everything is fine. It's like the world is ending and whatever.
Yeah,
and
there's
so,
a
Dan,
huge gap between theory and practice there, right? I mean, I think people routinely underestimate or overestimate, rather, their risk tolerance. But as you said, I have talked to a lot of clients who've said things like, if the market crashes, I'm just going to buy more, right? I'm kind of waiting on the sidelines. I want to say, no, you're not. Because when the market crashes, you're going to come up with all kinds of reasons why it's going to go down even further, right? And I mean, the number of times I've seen people, kind of give us a call after a market crash and say, I don't know, I have some cash on the sidelines. I'm really anxious to send it to you because the market's down 20% over the last couple of months. Zero, right? I mean, maybe it's happened. I can't recall it. I can certainly recall the other conversations where people have called and said, should we be getting out?
Yeah, totally. I tell people this all the time, that historical investment returns are easy to observe and difficult to capture. And that's exactly what I'm talking about, right? Like there's so much hindsight bias, and you can look at a chart of the past, even the past like 25 years, you've got the tech bubble, you've got the GFC, you've got COVID. And it's very easy to look at those charts with the benefit of hindsight and be like, oh, I totally would have sold there, bought there, sold there, bought there. But when you're at the hard right edge of a market crash and you don't know if it's going lower, and we're down 25%, and in your mind you're going, this could go down 50, you're very unlikely to time the bottom in the first place. But to your point, Dan, when things are crashing, it feels like the world is ending. You've got markets in turmoil blaring on the news. You've got like headlines coming out saying it's getting worse, it's getting worse. To overcome that and to just take like a robotic stance going like, objectively, I should be, and like you shouldn't have cash on the sideline, in my opinion, in the first place. But to assess that objectively and to actually nail the behavioral component of an experience like that is incredibly difficult. And I even find like some of my older clients who have been through it a number of times are the ones calling me saying like, I know what you're going to tell me, but I just need to hear it. Like, is everything going to be okay? Right. And they've been through all of these crashes and still have difficulty with that exact moment.
Yep. I remember at the bottom of COVID, AVUV, the Avantis small cap value, U.S. small cap value ETF, had been absolutely hammered. And I thought about like, maybe I should put some money into that, or like maybe I should borrow from my line of credit because I don't keep cash sitting around. But then I was like, no, I shouldn't, because those businesses really could be the ones that get completely eviscerated by this situation. And then of course it went on to return some ridiculous amount after that.
Yeah, well, that crash was much shorter than I think any of us expected it to be. And I
Yeah,
think it's the
true.
classic example, right? I don't mean to suggest again that one was different, but it was different in the sense that unlike a lot of previous crashes, that one had this huge health component to it.
Right.
Like we had clients who were literally not just concerned they might lose their life savings, they were concerned they might die, right? And
Yeah.
I'm
Right.
not saying that lightly. That was a genuine fear.
Yeah.
And so, really, do you think you were going to be in a position where you were going to confidently put money into the market in the middle of that? I mean, we rebalanced with clients, but we didn't get a whole lot of phone calls from people with sacks of cash ready to, enter the equity markets for the first time. So,
Yeah. Yeah,
yeah.
exactly. So composure is an interesting one. Like I think I've heard you say, Dan, and I hope I'm not putting words in your mouth, but I think I've heard you say that people should tend to be relatively conservative until they have actually lived through a crash.
Yeah, I actually believe that. I mean, I think that for a lot of young investors, and I probably first made that comment, when I was dealing with these kinds of questions coming out of, let's say, a 3, 4 year bull market, right?
Mm.
And people say, I have a high risk tolerance. I'm saying, how old are you, right? And how many times have you lived through a major market correction with an appreciable amount in the market? Right? I mean, you might have lived through 2008, but maybe you were in university or something. You didn't have any investments. Um, Unless you've truly lost a big chunk of your money, I don't think you really know what it feels like. And I don't think you can evaluate your risk tolerance because you really enjoyed the previous 4 years of very high returns, right? You don't really understand that risk until you've lived through it. And so I would say if you've literally never invested in equities before, probably don't jump into 100% right away unless you go in fully prepared that you could lose half of that investment and you really
Yeah.
mean it, right? Like that you don't just say you can deal with it and then if it happens, you panic and sell the other half.
Yeah. Yeah.
So, being battle tested really does help a little bit.
Yeah.
No, I got
I remember
absolutely
Andrew
berated
Andrew
for that.
Hallam gave us. I wish I should have looked the story up before we recorded this because it would have been perfect to talk about. But he told a story about being in a jungle somewhere, camping with a group of students or something like that, and apparently a village had been slaughtered there, and he had this crazy experience with what he would describe as a ghost. It was a dream, but it was just like this horrifying experience, and he woke up absolutely terrified. And he's comparing this to living through an actual market crash. And he says, like, if you ask me right now, do I believe in ghosts? No, I don't. But put me back in that place exactly where I was, and I was absolutely terrified of ghosts. And so he's saying the same kind of thing, that like you could say you can handle a 50% decline in your investment value, but until you've actually lived through it, it's pretty hard to know.
Yeah, the other way of looking at it though is like if you're just getting started in investing and you're only investing a couple of $1,000s and you lose half of that, well, you'll recover, right? And so maybe it actually helps you to lose that money, feel, that despair, that anxiety, learn the lesson, and then adjust your asset allocation after that point. I mean, I think either one of those two things is fine. The time to make the mistakes and misjudge your risk tolerance is when you're younger and you don't have a lot of money to invest. You don't want
Yeah.
to be doing it when you're in your mid 50s and within shouting distance of retirement and realize, yeah, I made a mistake.
Yeah.
Yeah.
I think, especially with young people, and I'm sure you guys have been through it as well. I'm going through it right now with a longtime client of mine who has 3 children, and they're gifting some money to the kids, and the kids' financial literacy is very, very, very low. And so, like, the first meeting is literally explaining what we consider to be the absolute basics, like what is a stock, what is a bond, what is inflation, what is interest, that type of thing, what is a TFSA. And so to take somebody like that, and even if a risk profile questionnaire came and said, high risk tolerance, but with low financial literacy and with no experience, and taking a pretty significant sum of money for these gifts and putting it into what we might think of as a higher risk portfolio with more equities, that could be damaging for a really, really long period of time too, right? Because if you were to experience that kind of volatility and that loss, it can spook you in the early part of your investing career, and you might then become a very conservative investor because of that experience, and then miss out potentially on decades and decades of compounding as well, right? So there's this kind of formative period, I think, where to your guys' point, it might make sense to be more conservative until you've gone through something like that, kind of regardless maybe of the amount of capital you have, just because people, if it's a small amount of money, that might be all you have in the world right now, and it might be a significant amount to you, even if it's only a couple $1,000s, right?
Yep.
Yeah, I know there's a paper on that that's specifically people who have had really bad experiences losing money in equities tend to be much more conservative in the future. Which I guess, I mean, it makes sense. Your personal experience colors your perspective.
Yep.
Okay, so we have risk tolerance, preference, financial knowledge, investing experience, risk perception, and risk composure. I think I got all of them. So all those come together to form a behavioral loss tolerance. The risk tolerance piece is that was the willingness to engage in financial behavior with an uncertain outcome and the potential for loss. That one is usually assessed using something called a psychometric assessment, where the best practice is to assess it that way. So that's going to be a questionnaire that has demonstrated reliability and validity in predicting the behavioral tendencies of investors. And those words in this context have pretty specific meanings. Reliability is the trustworthiness or consistency of a measure, and validity is the degree to which empirical evidence and theoretical rationales support an assessment. So you need to have an assessment that is reliable and valid. And then once it's been created and studied for its reliability and validity, then its results can be used to rank people who take the test in the future relative to the findings from a study. So typically how this is done is someone comes up with a questionnaire that they believe to be reliable and valid, and then they run a whole bunch of people through it. And then there are tests, I guess, to show whether it's reliable and valid. And then going forward, people who take that test are ranked relative to the initial sample population. So there are a bunch of software providers out there now that have done their own studies and have tests like this. I'll put a link in the show notes to one that is reliable and valid based on a 1999 study. Now, the fact that it's a 1999 study means the questions probably feel a bit dated. And I mean,
Ask them how they feel if their Blockbuster stock would fall
Yeah.
20%. Is that?
It doesn't mention Blockbuster. And I've gone through this test a bunch of times, and we actually use it for our clients at PWL right now. And a lot of people in the rational minded community took it too. I posted it in there, and I don't know, like hundreds of people took it. And I think it's easy to be critical of the questions because some of them are kind of funny and kind of weird. Like, oh, well, I would never do that. But I think if you go through the questionnaire, kind of like thinking about the spirit of what the author of the question was asking about, like it's obvious what they're trying to get out without you being like, well, I would never actually do that. Anyways, I think if you kind of take it in, I don't know, in good faith isn't quite the right term, but if you take it and just try and put yourself in the shoes of the author and what they were trying to ask about, I think it's fine. The questions are a bit funny though. I'd love to do our own study and have our own questionnaire, which is something that we may do in the future. But anyway, so we'll put a link to that study in the show notes, and people can take the quiz because the authors of that study publish their questionnaire online still to this day. So you can go and take it, and it'll tell you what your risk tolerance is. So then it comes back as a score telling you kind of how you rank. So you'll be like high risk tolerance, which means you're high relative to everybody else who's taken that assessment or the initial sample that the test was studied on. But the tricky thing about that though is it doesn't tell you that you should be like 100% equity. It doesn't say, oh, you've got a high risk tolerance, therefore you should be 100% equity. Somebody else has to do that. So like when we get the score from that test, we have to interpret it and map it to an actual portfolio. So at PWL, if someone comes back with a high risk tolerance, we map that to a portfolio somewhere between 70 and 100% in stocks. And then based on some of the other stuff, the other elements that we mentioned of a risk profile, and based on the advisor's input, they'll land somewhere in there. But we use the behavioral, we use the risk tolerance as the psychometric assessment as a constraint. So if you're high, then you're 70 to 100% equity. But if you're really low, then we're not going to. Then the advisor would have to kind of manually override and document why they're doing something different. Anyway, so people can take that quiz online. It'll tell you whether you're high or low or medium or whatever, but it won't tell you how to invest your money. You kind of have to figure that. You have to figure that part out yourself, I guess. I don't know. Makes it a little bit less useful, maybe. Now, one interesting insight from a big sample of a ton of cases that have been run through Morningstar's risk profiler is that risk tolerance follows a pretty normal distribution. Most people don't have an extremely high risk tolerance. Like there's not a big fat tail there. It's it looks like a very regular normal distribution. So again, to your point earlier, Dan, if you think you have a really high risk tolerance, statistically, like you probably don't. Most people don't. Most people are not sitting in that right tail.
Yeah. It's kind of interesting, how the questionnaire ranks you related to other people. Like I'm curious about the usefulness of that finding. Like, so for example, if you're an investor and you complete the questionnaire and it says, your risk tolerance is higher than 80% of the population. What do you do with that information? I'm just curious. Like it's interesting, like you say, oh, I never thought of myself as a risk taker. That surprises me. Or do you think people are more likely to say, yeah, that's sort of in line with what I expect based on talking to other people? Yeah, it's an interesting, because really your risk tolerance relative to other people is not really relevant in terms of your asset allocation decision. But it is interesting, and it does frame the discussion in a different way.
Yep. Yeah, and it comes back to how do you map the score? Because again, it's telling you how you rank relative to a bunch of other people. How does that map to an asset allocation? So we built our own risk profiling tool at PWL, and we had to do this. We had to do the mapping exercise. Prior to that, we're using Morningstar's tool, and again, we had to do the mapping exercise. Mm-hmm. So yeah, I mean, it's not something anybody gives you the answer to. There's a lot of subjectivity around if someone has a higher risk tolerance, what does that mean their portfolio should look like? The psychometric assessment does not give you the answer to that question.
Well, you've got those other two pillars to concern yourself with too, right? The ability and the need to take risks. So,
yeah.
Mm-hmm. What does it say about the other end of the distribution? Like, are more people very, very conservative than expected?
It's a normal distribution. Like the tails are not very big, and most people are sitting somewhere in the middle. Now on that, similar kind of related to what we were just talking about, another pretty interesting and related research finding is that men tend to overestimate their risk tolerance. So if you ask a man, what do you think your risk tolerance is, and then also get them to do an assessment, they will tend to overestimate relative to where they land on the assessment, and women tend to underestimate it. And that's also research from John Grable. And that holds for other factors linked to risk tolerance like age, household income, marital status, and education. And then that same study also finds that risk tolerance is overestimated by younger respondents and those with a graduate education. It's like a kind of overconfidence maybe, but just something to keep in mind. Again, when you're thinking about how risk tolerant am I, men are more likely to overestimate it. Okay, so this is really important. This behavioral loss tolerance piece is really important because investing in a risky portfolio and then selling out after it does poorly can be really expensive. And it can be really psychologically uncomfortable to be invested in something that is too risky for you after the fact. You realize it's too risky for you after the fact. Ken French was a while ago. It was episode 100. And there was something going on at the time that was causing market volatility. And we asked Ken French about changing your portfolio after a downturn. And his answer actually really surprised us at the time because, we thought, well, you stick with your asset allocation. And Ken said, it's kind of like the risk composure thing. Ken said, if you're really stressed out about your portfolio after a market decline, you've learned something really valuable about yourself. Maybe you should go and change your portfolio to be more conservative. Just don't go and change it back after markets recover.
That's the key piece right there. And I've had that discussion with clients before, right, who have called and said, I want to decrease my equity allocation. And, I've sort of diplomatically said, that's fine. Like if we agree that your risk tolerance was overestimated and that this more conservative portfolio is more appropriate. Let's just agree, though, that this is, I don't want to say a permanent decision, but this is a long-term decision. We're not going to have this discussion in 6 months when the markets have recovered and all of a sudden you're way more risk tolerant than you were before. So I think it's true. Like if it's quite possible that you are so bothered by the volatility during a certain period that you just say, you know what, this is not for me. I'm going to go down to 40% equities or 50. This 70 is just totally inappropriate for me. Fair enough, right?
Mm-hmm.
I mean, better to make that mistake now and correct it.
I think going the other way is really tricky too. Like I've had conversations lately with clients who are like 70-30, 80-20 investors who are like, let's crank it up to 100%. Like they just feel that the markets, we haven't really seen much volatility since I guess about 2022, right? But I mean, that feels like a long time ago now. We're 2025. It's a few years ago really. And people are like, no, I can stomach more risk because markets are going up, right? And so they adjust to recent performance in the opposite direction, which can be detrimental as well, obviously, over the long run, right? So it's just funny how we react to recency bias. And there's somebody, I can't remember whose quote it was, but it's like nothing like price to change sentiment, right? Like things are going up, everyone's just like, oh, then I need to buy more and chase those returns. When things are going down, like, oh, I need to get more conservative and chase safety.
Yeah, the joke is I have a high tolerance for upside volatility.
Yeah, exactly. Yeah,
but only in that one direction.
Yeah,
it is funny. Okay. So you're probably better off in a less risky, lower expected return portfolio that you can stick with and won't be stressed out about through bad times. So I call and we actually model in our risk assessment tool behavioral loss tolerance as a binding constraint on asset allocation. So if your behavioral loss tolerance says you can't be more than 60% equity, even if you score really high on everything else that would otherwise increase your asset allocation, it is constrained by behavioral loss tolerance. We also use your ability to take risk as a binding constraint. Even if you max out the behavioral loss tolerance scale, you can't take much risk measured by downside volatility with the money that you need to pay rent tomorrow or buy groceries or whatever, invest in your business. I don't know. So risk-taking ability is your ability to withstand declines in your portfolio value without compromising your lifestyle. We know risky assets like stocks have positive expected returns, but they can also drop in value pretty significantly over the course of months or even years. Risk-taking ability breaks down into 3 elements. So we've got the time horizon for the goal, the ongoing need for liquidity from the portfolio, and your capacity to absorb a financial loss without compromising your standard of living. All else equal, a longer time horizon, lower liquidity needs, and a higher risk capacity imply a higher risk-taking ability. So as an example, and this is from Grable's CFA textbook, if you have a time horizon of less than 5 years before needing to access the full amount invested, or if you need to access 5% or more of the portfolio annually, and if you have no other assets or income sources to maintain your standard of living, you have a low ability to take risk. And then at the other extreme, if you've got a long time horizon, say it's 10 years or longer, you have no ongoing liquidity needs, and you have other assets or income streams sufficient to maintain your lifestyle if this specific investment we're talking about, the risk, the ability to take risk for, goes south, goes down. So say you've got a pension, for example, that's a backstop even if you lose your investment, then you have a high ability to take risk. Your human capital, and Mark, you mentioned disability insurance earlier, which is relevant here. Your human capital, which is your ability to work and earn income, also contributes to your ability to take risk. If you've got really stable employment income that's not really affected by the broader economy or affected by the stuff that would affect the stock market, your human capital is kind of more bond-like, and it allows you to take more risk with your investments. You have a higher ability to take risk. Classic example is like a tenured professor. Like their income's probably not going to change much. And then on the other hand, if your income is unstable and has the potential to drop in bad economic times, then your human capital is more like a stock. And that allows for less risk-taking with your investments, all else equal. So that's ability to take risk. And then disability insurance, I think, fits into that nicely, Mark, because in either of those cases, if you became disabled, all of a sudden that asset goes to zero unless it's been properly insured. Okay, so then the last dimension in assessing how much risk to take is your need to take risk. So behavioral loss tolerance and risk-taking ability are constraints in the amount of risk that you can take, but someone with a high loss tolerance, behavioral loss tolerance, and high risk-taking ability, they may not need to take a lot of risk. Riskier investments have higher expected returns. That's why people invest in them. Someone who's very wealthy may not need to have a high expected return to meet their long-term objectives. So in assessing your need to take risk, I think you need to understand the rate of return required to meet your goal. And if your goal can be achieved with the expected return of a low-risk investment, it's worth asking why you would want to take more risk. There can be reasons, like someone might change their goals. Oh, wow, I can already retire, then maybe I want to leave a really big legacy. But those are the kind of questions you have to ask.
I like to frame that one when I speak with clients about, and I think I stole this line from Larry Swedroe. I definitely didn't make it up, but it was, the idea is you should take as much risk as you need to, but no more, right? Because sometimes, you will have clients who will say, well, I'm thinking I should increase my equity allocation, and they might already be retired or close to retired. And it's like we've done the plan, we've run the what if scenarios. You don't need. I mean, you could achieve all of your goals with, let's say, a 4% return. Why do you want to shoot for a portfolio with a 7% expected return and a lot more volatility? There's no real additional utility in your life, probably. It might mean you leave a larger estate, which may or may not be important to you. But, why do you want to choose a rougher ride for something that will not improve your life? And usually when I frame it like that, people say, yeah, that makes sense. Let's leave it where it is.
Mm-hmm. Yeah, no, I agree. I think it's an interesting trade-off between the need for risk and the desire for risk. And then also in these examples where you've got somebody who's very wealthy who doesn't need the risk, I generally agree, right? Like ideally you get to meet your financial objectives over the long run with the least amount of risk possible. But then also because you're so wealthy, you have such a high capacity for risk, right? So that that needs to be balanced in these discussions, because it's like, well, you can tolerate 30, 40, 50% drawdowns now without it materially affecting your long-term ability to meet your goals. So I've had some clients who want to take more risk because they're in that position, and others who want to take less risk because they're in that position.
Yeah, and especially if your goal is to leave a large estate, then the time horizon for that money is much longer than the time horizon of your own life. So but again, I think all of this comes down to your tolerance. You might have the capacity for your portfolio to fall 30 or 40%, but if that would, cause you to lay awake at night for weeks, you don't really have the ability to do that. Right?
Yep.
Yeah. Yeah, that stuff's expensive. Like being stressed out is no joke. Not financially expensive, but it takes a toll.
Well, and that wealth is supposed to relieve some of that anxiety, not add to it. But so frequently it does add to it, right? We know that.
Yeah. On need, the risk need, the other thing I'd be cautious of is that if your goal requires, so we would establish this using financial planning software. We put all of somebody's information into the software, and it'll tell us based on an asset allocation assumption, which is associated with an expected return, whether the goal is attainable. If a goal is only attainable with an extremely high expected return, like say a 20% return required to meet the goal, it probably makes sense to revise the goal. Like we would say, this goal is not attainable. But somebody that's doing this on their own might think that they can get, 12% or 15% or whatever, doing some type of investing. But I would be very careful there. There is an interesting idea here, though, that some people invest in lottery-like assets. Like it could be like meme stocks. It could be GameStop, which I guess is a meme stock. It could be meme coins. It could be thematic investments. Those all have lottery-like payoffs. Like you're usually going to lose, but sometimes you can win really, really big. I think Mayor Statman talked to us about this. Some people invest in that type of investment because it does give them a low probability of hitting that really high return to meet a goal. If you have a goal that's not important, like if the damage of not achieving that goal is not very significant, then I'm not recommending people invest in lottery-like assets. But I can see the justification for doing so, I guess is what I'm saying. Mm-hmm. Okay. So, and on that conversation about how much risk you should take if you don't need taking as much risk as you need, but no more. That gets even muddier when we introduce this next topic, which is that we've been talking about risk as downside volatility, the probability of losing money on an investment in the short term. But as we said earlier in the episode, that's not the only relevant measure of risk. We know stocks are volatile. They move up and down a lot day to day and year to year. And that's typically how risk is framed. Like all the risk questionnaires and everything that the financial industry uses are based on risk as volatility. But long-term investors are less affected by short-term volatility. We know empirically that low stock returns, and this is a pretty noisy relationship, but it is there. Low stock returns tend to be followed by higher stock returns, and higher returns by lower returns. That's called serial dependence or negative autocorrelation. And that feature of stock returns decreases the risk of stocks for long-term investors relative to if returns were just random. Bonds have historically exhibited positive autocorrelation, meaning that bad bond returns tend to be followed by more bad bond returns. And that's typically related to periods of high and persistent inflation. I do need to specify here that we're talking about nominal bonds in the U.S. TIPS or inflation-protected securities. They would not have the same problem, or at least it would express differently. In Canada, we're phasing out our real return bond program, so they're less relevant up here. They've also got weird tax effects, and they can still be super volatile in the short term. But anyway, we're talking about nominal bonds. That positive autocorrelation of nominal bonds makes them riskier at long horizons than at short horizons. So now we have stocks getting a bit safer at long horizons and bonds maybe getting a little bit riskier at long horizons. And then bonds also tend to have lower expected returns overall and to be occasionally devastated by periods of high inflation. So in their own way, they can be kind of risky. Stocks are by no means an inflation hedge, since they don't necessarily increase in value when inflation is high. But they have historically been able to outpace inflation at long horizons most of the time because they've just got higher expected returns. So stocks are more volatile, which is one important way to think about risk for all the reasons that we just went through. But they've also been quite a bit less likely to lose purchasing power at long horizons than bonds have, which is another way to think about risk. If we believe that those characteristics of stock and bond returns will persist, that stocks will have higher expected returns and that they'll have a bit of mean reversion, and the bonds will have lower expected returns and have a bit of mean aversion, then optimal portfolios for long-term investors would generally have higher stock allocations relative to if those things were not true. So behavioral loss tolerance and the ability to take risk are still super important constraints on asset allocation, but I think long-term investors just need to understand how risk changes from a short horizon to a long horizon. And I think this also connects back to the financial knowledge and investing experience inputs in assessing risk tolerance. If you can withstand volatility in the short term, there's a reasonable argument that higher equity allocations are a bit safer for long-term investors. I'm not saying 100% equity. I'll go through an example in a second. And that's true even for retired long-term investors. But you have to get that. You have to understand the concept of why you're enjoying this volatility to live through it. So there's a 2024 CFA Institute research paper, Investment Horizon Serial Correlation and Better Retirement Portfolios. They model optimal asset allocation using historical data, and they find optimal portfolios for long-term investors tend to have higher equity allocations if you use historical data compared to if you use like Monte Carlo simulation, which is random. It doesn't have the serial correlation piece in there. So for example, the optimal equity allocation for an investor with a low risk tolerance who's concerned about their inflation adjusted wealth moves from an optimal in their model, an optimal 20% in stocks at a 1 year horizon, all the way up to a 50% allocation to stocks at a 20-year horizon. So that horizon makes a big difference. And then the Scott Cederberg research, of course, which listeners are probably familiar with, they come to an even more extreme conclusion, suggesting that 100% stocks is the best portfolio or the least risky portfolio for long-term investors, including for retirees. Now, even if we take Scott's research and say, yeah, we agree that's true, there's still a massive behavioral risk tolerance component there. That still is a binding constraint.
Yeah, it seems to me, that virtually all of this discussion has to be considered in terms of that behavioral risk tolerance. Because, I mean, let's agree that if your time horizon was infinite and your behavior was perfect, it's pretty hard to argue against anything other than a 100% equity portfolio. But the
Yeah.
problem is neither of those two things are true for anyone, right?
Yeah. Yeah.
So it's those constraints, I think, that are going to really govern the decision. I mean, nobody's arguing that over a 50-year, even over a 20 or 30-year time horizon, that 100% equity portfolio is going to have the highest expected return, but only if you stick to it. So,
I think the interesting piece on that is people would agree with that in general. I think the surprising thing from the Cedarburg research and even from that CFA Institute research brief is that even if that's true, even if you're withdrawing from a portfolio. Like, I think people get really worried about sequence of returns risk. If you're spending down a portfolio, like everyone agrees, yeah, stocks have higher expected returns than bonds. This recent research, though, is suggesting that even if you're drawing down a portfolio, stocks are actually a higher allocation to stocks is actually a bit safer than a higher allocation to bonds. But yeah, I agree with you, Dan. Like, all of this is completely irrelevant if somebody can't stick with the portfolio.
yeah, it's also, I mean, let's quantify the risk too. Like the risk of running out of money is catastrophic, right? Like it is something that you cannot under any circumstances tolerate. Whereas the risk of missing out on some other financial goal might be much less severe.
Yep.
So, it's the classic Russian roulette thing. Like you win 5 times out of 6. Great. But the one time you lose big. So you
Yeah.
cannot take that bet. So, I mean, that's an extreme example, but you see what I'm getting at. Like,
Yeah.
I think any retired person drawing down their portfolio wants to have a pretty close to zero chance of running out of money, not, a suboptimal portfolio that
Yeah.
might in 15% of the time or 20% of the time, right?
Yeah.
So,
I think
Yeah, it's
that's
interesting because
true.
when we think about like low, I was actually having this conversation on Twitter just this morning. It's funny we're recording this today because I tweeted out this morning, intentionally, somewhat provocatively, that I can't think of any situation where it makes sense to have zero exposure to global equities. Right now, I'm talking long-term portfolios. Sure, you're saving up for down payment for next year. Like, yeah, you don't want exposure to global equities, but over a long horizon. And what I'm really getting in that tweet is more like market timing, like going to cash and waiting to see what happens, kind of thing. But also, even low-risk investors. So somebody came back and was just like, no, a low-risk investor should have a portfolio of locked-in 5 to 10-year GICs at 5% kind of thing. I'm like, well, look, there's a lot of risk trade-offs in doing that. Like now you've got liquidity risk because your money is locked up. You've got inflation risk, Ben, as you pointed out, with bonds and their serial autocorrelation rather. GICs probably experience the same thing because it's a fixed income, and there's reinvestment risk now as well, and interest rate risk. So it's a series of trade-offs always when it comes to risk, right? And even like dealing with hundreds of clients over the past 15 years or so, like even low-risk investors, I can generally see why something like 15 to 20% global equity exposure and 80% fixed income, that's still a low risk portfolio. Like the type of person who would go 100% cash and GICs, that's effectively a no risk portfolio when viewed through the lens of volatility, right? So when we're talking about like low risk and being conservative, even in my mind, I'm not thinking like cash under the mattress type thing.
Yep. Makes sense. Okay. So yeah, last piece on this topic is thinking about the type of risk that you're taking. I'll often see risk-seeking investors, and it kind of ties back to the lottery-like assets maybe that we were talking about earlier. But anyway, risk-seeking investors will try to increase their returns by holding big positions in one stock or betting on one industry. I would say it's probably not the right kind of risk to take. You expect a higher return for owning a diversified portfolio of stocks over bonds. That expectation has to be there for investors to be willing to hold riskier stocks instead of safer bonds. That's a compensated risk. It's there empirically. It's there theoretically. There's a good reason to expect it to persist. The specific risks of individual stocks or individual industries are not compensated risks. You might do better, you might do worse, but the outcome is random around that. They're not risks with positive expected returns. It's closer to closer to well, I was going to say gamble, but as someone once pointed out to me, some forms of gambling can have positive expected returns if you know what you're doing. So I won't use the word gamble. It's a negative expected return, or at least a random outcome. So in general, I think it makes sense to diversify away individual security risk and industry risk as much as possible. If people really want to have higher expected returns, if they want to take on more compensated risk, they can increase their allocation to stocks relative to bonds. They can increase their allocation to risky stocks like small cap value stocks. They can allocate to other established expected return premiums, which could mean a lot of different things. And we'll actually talk about that in the after show. They could use leverage, which has its own trade-offs and downsides and messiness. Or they could do some combination of all of those things. But I think it's really important to remember. And I think this kind of goes back to your comments earlier, Dan, about how people say, like, yeah, I've got a really high risk tolerance, even though they may not actually have it. People get excited about taking risk. But risk is risk. Like it's risk for a reason. Risk premiums don't always pay off over all time periods. Like I mentioned, small cap value stocks. If you've been in U.S. small cap value stocks for the last 20 years, like good luck. I mean, it's been a pretty rough period. Leverage amplifies both good and bad outcomes. It's not like you just lever up and you're off to retirement. It's possible, completely possible, that taking more risk leads to worse outcomes rather than better. Okay, so risk is multidimensional. Your psychological constitution and your financial situation are constraints on how much risk you can take. Even if you can handle a lot of risk psychologically and financially, you may want to dial it back if you don't need to take a lot of risk to meet your goals. And then I think it is important to just be aware of the fact that the nature of risk changes at long horizons. Even a conservative long-term investor, and we saw that from the CFA study, even a conservative long-term investor should likely have an unallocation to stocks. And I mean, in that paper, it said a 50% allocation to stocks instead of I think a 20% at a 1 year horizon. Lots of subjectivity around that, but point is, if you can meet your goals with the expected return of bonds, I don't know if it means you should be 100% in bonds, at least not nominal bonds. Long-term investors concerned with their inflation-adjusted wealth may find that a higher allocation to stocks is contrary to popular wisdom, safer than a more bond-heavy portfolio, with the caveat that it doesn't cause behavioral problems, which, as we've talked about, is super important. And the last thing to summarize is that investors who want to take more risk should consider taking compensated risks rather than speculative ones.
That's a super important point right there, right? Like when you said a minute ago that sometimes riskier portfolios will result in, worse outcomes. If you take poor, uncompensated risks, that's the most likely scenario. Right?
Yeah.
That's not just a fringe possible outcome. That's what's most likely going to happen. If you take compensated risks, obviously your probability goes up dramatically.
Yeah, totally. Anything else to add on this topic?
I wanted to ask you a quick question about how you guys feel about sort of, let's call it perceived risk. And the context here is Justin Bender and I did a piece in the Globe and Mail, I think it was probably a year and a half ago or so, where we were comparing bond ETFs versus GIC ladders. And, just as an example, we would say like compare a short-term bond ETF that holds bonds from 1 to 5 years versus a ladder of GICs with maturities 1 to 5 years, and you roll them over every year. And our argument was that, the GIC ladder is likely to deliver slightly higher return over time because you're compensated for the illiquidity, right? And not only that, we made the comment that a GIC ladder has no volatility. A lot of people took issue with that and said, well, that's a ridiculous statement. If interest rates go up or down, the value of those GICs changes. And if they were marked to market every day, they would go up and down in a similar way to bonds, which is 100% true. But it kind of misses the point because most investors do not think of GICs in that way. And if they buy a GIC for $50,000 and every day they look at it it's $50,000 plus accrued interest. In their mind, that's zero volatility. Now, is it an illusion? Of course. But if the whole point of adding fixed income to a balanced portfolio is to reduce volatility in order to regulate your behavior, then it's done its job. It doesn't matter if it's an illusion, right? So if you want to look at the economic theory of it and say, well, a GIC is worth less if interest rates go up. You're correct. But in practice, that doesn't mean anything. It has no impact on an investor's behavior. So I'm throwing that out to see what you guys feel about that as a sort of risk versus a perceived risk.
Can I introduce you to private credit?
Please do.
That's the whole argument, right? I mean, like, and I have friends who use a lot of alternatives in their portfolio, no, and this is the exact argument. They're like, do I have a duty to like, even if it's volatility laundering, and I know GICs aren't really the same from that perspective.
Yeah, because they're guaranteed, right?
Yeah,
private credit
sure.
is not.
Yeah, absolutely. Private
difference.
equity and private real estate funds, but these funds are products that are not marked to market and are valued infrequently. Even if, like, and the advisors themselves that I speak with know that yes, like the real value of this has gone down, but the clients are going to see that, and if that improves their outcome over time, you know, let's discard the high fees and everything else. If that improves the outcome over time from a behavioral perspective, do I have a duty to that client to at least consider these things as part of the recommendation? So it's a really, really interesting question and not one I've got a great answer to. I do agree with you, Dan, that psychologically that lack of volatility can be a good thing. Absolutely. If, and as we discussed earlier, if you can meet your objectives with less risk, why not consider it, right?
Yeah, I think, again, with the private credit thing, I mean, the issues there are probably the costs and the credit risk. It's not the illiquidity,
Yeah.
right? But I mean, I would look at this in the same way I would look at, you know, when someone buys a house, for example, you know, and they say, well, it's not a volatile asset. Well, real estate goes up and down every day in value theoretically, but for all intents and purposes, nobody has a ticker on their house that, you know, lists the exact value of their home at this moment. And if they did, they would probably have a lot of stress as a result, right? And the fact that it is not mark to market every day and isn't always in your face, right, allows you to hold that asset with a little more equanimity than you would a truly volatile asset. And I think sometimes you can harvest a little bit of that behavioral bias and use it to help a client, not to deceive them. Right?
Yeah.
Yeah,
you
I
say
think we talked about
equanimity?
this for asset location too. Like if you shovel all of your fixed income into the RRSP account, that effectively increases your allocation to equities on an after-tax basis, which is what actually matters to your future consumption. So now you've got a riskier portfolio objectively, but it looks like it's less risky because you've got what you see in your accounts is this big chunk of fixed income in your RSP account. I think the similar idea. There's a pretty strong behavioral argument to look at it like that.
Yeah.
Yeah, for the GICs, I think it does make sense that it would help people feel better. And that's, I know the analogy to private equity and private credit is not great because they're not guaranteed like a GIC is, but conceptually it's kind of similar where people have demand for the smoothing effect of illiquid assets, regardless of what the underlying is, because it makes their portfolio look less risky, even if that's not true at all economically. It makes it look less risky, and that makes people feel better. An interesting thing there on the illiquidity premium is that Antti Ilmanen has written about this, about how if there's so much demand for that smoothing effect, it could actually flip the illiquidity premium negative because people are so willing to pay for the smoothing effect in their portfolio. I have no idea if that would show up in the GIC market, but it is interesting. So yeah, I think totally.
You can easily compare that just by looking at GICs compared to Government of Canada bonds of the same maturity, and there's a premium, right? So, but that's a good point. Yeah, if people value it so much, in theory, it could drive the price up and kind of take it away. But I think as long as it's an illusion, right? And it kind of is, why not harness that, right? Rather than sort of arguing that it's nonsense and that you're fooling yourself, saying, okay, maybe I'm fooling myself. But if it's, if it gets you, because like I said, you always have to start from the position that you're not adding bonds and GICs to a portfolio to boost the expected return. You're adding them to lower volatility and make you a more disciplined investor. And if you can accomplish that goal with an illusion, you've still accomplished the goal. Maybe you're
Yeah, it's
doing the
interesting.
right thing for the wrong reasons, but that's okay.
That's interesting. Yeah. It's a
Yeah.
behavioral argument anyway. So
Hmm.
why not continue to push the behavioral argument?
Well,
Exactly.
and the type of
Yeah, no,
people
I
that
love.
might benefit from that are likely not the type of people who understand mark to market pricing and fixed income pricing
Right.
mechanics in the first place, right? So the people who are complaining about your article, Dan, and saying, well, no, if you marked GICs, like those are not the people that, because of their financial knowledge, obviously, they probably have a high enough risk tolerance that they don't need to fool themselves into the illusion of
Yeah,
that smoothing effect of GICs anyway.
I think that's fair.
I like that argument though for GICs.
Well, we certainly saw it in 2022, right? I mean, we had people who loved holding GICs in their portfolio and despised holding bonds. And if, you're going to argue that they're the same and the economic impact of rising interest rates is the same, you're theoretically correct, but it doesn't really mean very much to the end investor who's
Yeah,
living through
no,
it.
it's a great argument.
And there's also like cashable GICs too, which I find to be quite compelling, where if you hold it for 30 or 90 days, your interest rate's guaranteed for the full year, but now they're liquid after that 30 to 90 day period. And I think those are a really interesting sort of middle ground too, right? You've got the guarantee if rates don't change, or if rates have gone down, then you can hold it. If rates have gone up, then you've benefited and you can cash it out and reinvest.
Yep.
GICs are equivalent to CDs for our American listeners. Short-term guaranteed deposits that are locked in for a period of time and tend to have pretty good returns relative to government bonds, for example.